Page 163 of the Reference Guide to Regulatory Compliance within subsection 2, Credit, titled Fair Lending. And during the early 1990s, federal banking regulatory agencies and members of Congress expressed increasing concern that some financial institutions across the country were engaging in discriminatory lending practices. Widespread attention was given to a study conducted by the Federal Reserve Bank of Boston, published in 1992, and to a Justice Department investigation of an Atlanta financial institution that was settled the same year. Since that time, the federal banking agencies have issued statements and guidelines to encourage banks to take affirmative steps to avoid discrimination in the lending process. The term fair lending primarily refers to two layers, the Fair Housing Act and the Equal Credit Opportunity Act. The Fair Housing Act is a civil rights law that makes discrimination in housing lending illegal. The ECOA is a customer protection law prohibiting discrimination in all types of credit, both consumer and commercial, and requiring that certain notifications be given to loan applicants. ADA, the American with Disabilities Act, also bears on lending activities. Banks are obligated to reasonably accommodate individuals with disabilities when they apply for loans, as well as during the entire lending process. Other laws, such as CRA, the Community Reinvestment Act, and HMDA, the Home Mortgage Disclosure Act, are closely related and play a part in the fair lending process, although their purpose is not specifically to prohibit discrimination. CRA encourages lenders to be active in marketing and lending to all segments of their communities, especially low and moderate income persons, small businesses, and small farms. Low and moderate income neighborhoods often contain disproportionately large numbers of protected classes, minorities, women, and contain disproportionately large numbers of protected classes, minorities, women, and the elderly, and so forth. HMDA aids in the process of regulatory monitoring by requiring disclosures of home loan applications made each year by each lender. Since the 1992 studies, the federal government's action in the fair lending area has escalated substantially, and state and local governments have entered the fray. In January of 1994, President Clinton established the Fair Lending Council, and in February of 1994, a coalition of 10 federal agencies issued a joint policy statement on fair lending. The Fair Lending Initiative provides guidelines to lenders on the factors that will be used to determine whether discrimination exists within a lending institution. All 10 participating agencies use the joint policy statement as a tool to discover discriminatory activity. In 2009, the banking regulatory agencies revised their uniform fair lending examination procedures. The new procedures clarified examination procedures relating to pricing, steering, redlining, and broker activity, performing examinations with small sample sizes, and data accuracy. The banking agencies have considered the use of testers in fair lending examinations, and the Department of Housing and Urban Development, HUD, has awarded mystery shopping contracts to a multitude of organizations, including city government units and grassroots community groups. During the decade of the 1990s and the first decade of the 21st century, several referrals of apparent violations were made by the banking agencies to the Department of Justice and HUD. Some banks that were accused of discrimination agreed to large monetary settlements and the implementation of remedial activities to prevent such activity in the future. Institutions may not realize that fair lending issues go far beyond more loan inquiry and product information stages, counseling about credit qualifications, and suggestions to help the prospective borrower over hurdles. Banks should be aware that fair lending also encompasses setting the terms and conditions for approved loans, collateral, length of term, and so forth, pricing, interest rates, fees, down payments, and so forth, and or override of exceptions, both of loan decisions and loan pricing. From time to time, individual agencies have published guidances targeting special subjects. For instance, in 1997, the OCC published an issuance on credit scoring. Note, no regulations exist for fair lending. There is only a joint policy statement. Since the authority for the administration of ECOA transferred to the Consumer Financial Protection Bureau in 2011, part of Fair Lending Administration transferred as well. Responsibility for the Fair Housing Act remained with HUD and the prudential banking agencies. Coverage of joint policy statement on fair lending. Any person subject to the authority or jurisdiction of any of the following agencies are covered, and that's HUD. The Department of Justice. HUD stands for the Department of Housing and Urban Development. The Department of Justice, the DOJ, Office of Control of the Currency, Federal Housing Finance Board, subsequently merged into the Federal Housing Finance Agency, Office of the Federal Housing Enterprise Oversight, subsequently merged into Federal Housing Finance Agency as well, Board of Governors of the Federal Reserve System, Federal Deposit Insurance Corp., National Credit Union Association, Federal Trade Commission, and Consumer Financial Protection Bureau. Laws that are covered are the Fair Housing Act, as we discussed, ECOA, and that's actually it. And within these sections are the actual protected classes. So for Fair Housing Act, the prohibited discrimination in all aspects of residential real estate transaction on the basis of race or color, national origin, religion, sex, familial status of children under the age of 18 living with a parent or guardian, pregnant women, persons with custody of children under the age of 18, and handicap. ECOA prohibits discrimination in all forms of credit transactions on the basis of everything being the same, that's race or color, national origin, religion, sex, marital status rather than familial status, and handicap is not there, but we do see the receipt of public assistance income and good faith exercise of rights under the Consumer Credit Protection Act, and forgot to mention age. Types of discrimination, you have overt, disparate treatment, and disparate impact. Overt is open discrimination. This type of discrimination occurs when a lender blatantly discriminates against an individual or class of persons. Expression of discriminatory preferences, and overt discrimination occurs if the lender expresses a discriminatory preference even if the lender does not act on the discriminatory expression. Evidence of disparate treatment requires different treatment based on a prohibited basis. It does not require actual intent to discriminate. It generally affects applicants requiring more lender discretion. In other words, applicants who are either not well qualified or clearly not qualified. Lenders have the burden of proving the disparate impact of similar applicants was not done on a prohibited basis. Disparate treatment on a prohibited basis may be established by valid statistical analysis of loan file information. Evidence of disparate impact, this time impact, occurs when a policy or practice is applied equally to all participants but has a disproportionate adverse impact on a protected group. It does not require intent to discriminate illegally, and the policy or practice that adversely affects protected group may not be legal if it is justified by business necessity and a less discriminatory alternative is not available. The Interagency Fair Lending Examination Procedures, subsection 3. The following are criteria published by the FFIEC, Federal Financial Institutions Examination Council, that are used by the FDIC, OCC, and the Fed and the CFPB when examining an institution for compliance with the fair lending laws. There are two basic parts to a fair lending examination, that's scope and intensity. Scope includes the following elements: your examination scope guidelines, where the examiner will focus the examination based on 1, the understanding of the credit operation of the institution, 2, the risk that discriminatory conduct may occur in each of those operations, 3, the feasibility of developing a factually reliable record of an institution's performance and fair lending compliance in each of those operations. And examiners will seek to understand the institution's credit operations. In that, examiners will consider types and terms of credit products, any special purpose programs or programs designed to assist certain underserved populations, volume and growth in each credit product offer, demographics of the credit markets in which the bank does business, institution's organization of credit decision-making process, institution's loan officer and broker compensation practices, types of relevant documentation available for various loan products, and the extent to which information requests can be organized and coordinated with other examination components. Examiners will determine whether subsidiaries should be examined. Underwriting standards and procedures are used in related entities. The portfolio consists of applications from a purchased institution. The portfolio includes purchased loans. A credit decision can be made with independent authority at more than one place. And these are all things that the examiner considers. Moving forward, they consider decision-making responsibility for a single transaction involving more than one underwriting center, applicants being steered from the financial institution to a subsidiary or other lending channel, and what policies and procedures exist to monitor this practice, and any third parties involved in the credit decision and how responsibility is allocated. Evaluating the potential for discriminatory conduct, factors that an examiner considers is 1. Which credit and prohibited basis are reviewed during the previous exam, which prohibited basis groups make up a significant portion of the institution's credit market, and which products and prohibited basis groups the institution reviewed in a self-test. This is kind of like a risk assessment that the examiners perform. It's the potential for discriminatory conduct. Within that, the examiners will develop an overview of the credit operations and credit products offered, including underwriting guidelines, policies, and standards, descriptions of credit scoring systems, including factors scored, pricing policies, description of compensation systems, including whether it is related to loan production or pricing, and formal and informal relationships with financing companies, subprime mortgage, and consumer lending entities. And this is all when the examiners develop an overview of the credit operations and credit products offered, also including the loan application form, the HMDA LAR, loan application register, the description of databases maintained for loan products to be reviewed. Further, within the overview of credit operations and credit products, the examiners include the description of databases maintained for the loan products to be reviewed, records detailing policy exception or overrides and processes to monitor these, copies of consumer complaints alleging discrimination in related loan files, compliance program materials, and lastly, copies of available marketing materials and previous marketing programs. Examiners will also identify compliance program discrimination risk factors, including potential risk factors such as 1 through 6. 1 being overall institution compliance record is weak. 2, prohibited basis monitoring information is incomplete or non-existent. 3, data or record-keeping problems compromise reliability of previous examination reviews. 4, fair lending problems were previously found in one or more bank products. 5, the size, scope, and quality of the compliance management program is materially inferior to those at similar institutions. 6, the institution has not updated compliance guidance to reflect changes in law or agency policy. And 5th, fair lending training is non-existent or weak. D, examiners will review residential loan products and consider the following types of home purchase, home improvement, and refinancing. That's for government-insured loans, mobile and manufactured housing, wholesale and direct and brokered loans, and portfolio lending. The focus of an exam will be limited if the examiner determines that the institution has a strong compliance program, no record of discrimination, no indication of significant change in personnel, operations, or underwriting, no unresolved fair lending complaints, preceding litigations or similar, and no discretion to set price or credit terms in particular decision centers or for residential products. Examiners will identify residential lending discrimination risk factors, and I will discuss those in the next session. I'm ending here on page 167. Risk factors the examiners consider.